Hello, welcome to Accountant's Minute. Today's theme is looking at a new concept for accountants, predictive accounting. Predictive accounting relates to budgets, cash flow forecasts, and projected balance sheets. But at the very beginning, it's very necessary to have collated information into the key drivers. So let's just go back to the beginning. Many accountants, many of you, hopefully have been asked by your clients to prepare business plans. The business planning process requires you to sit down with the leadership team and the board of directors and work through a whole series of items, in some instances well over 40 of them, looking at a whole range of issues relative to a business. And from that, the leadership team and then the board of directors is able to establish their vision. And once the vision's been established, you can then document the strategies that are going to be required to implement that vision. The next step is to then implement that vision. And implementing the vision is very difficult. One of the key documents that can be produced is the financial picture of what is contained within the business plan, within the vision and the strategies. Put it into a financial picture, which is what predictive accounting is achieving. So we start first of all with the key drivers. The key drivers enable you to document the various facts and figures that relate to a whole range of items that then can be incorporated within the budgets and the cash flow forecasts and the projected balance sheet. Information to go into the key drivers includes the sales estimates. What's the sales department think they're going to sell? We can then move into the production targets. Based on those sales estimates, what are the production targets? That's going to require looking at the completed products that are on hand at present. There may have been more left over from the previous year than what was originally contemplated. Are there seasonal conditions which mean that the business needs to build up a buffer of stock at certain times in the year because it's difficult to get supplies of raw materials at that stage, or because customers require significantly increased quantities of goods to be sent to them at various times, for example, in the couple of months before Christmas? What team is going to be required to produce the production? Who are those team members? What's their classification? What's their working hours? What's their expected productivity? What's their labour cost? The labour on cost also needs to be calculated. Their benefits, superannuation, penalty rates, holidays, etc. What raw materials does the business need to be able to produce the goods? And is there any special requirements to stockpile raw materials because of potential shipping problems or supplier difficulties, as we've seen over the last 15 months in various industries? The next item to look at, I think, is creditors. What's the payment terms that your clients' creditors have imposed? And what negotiations could take place there? What are the marketing costs for general marketing, social media, various promotions, sponsorships? Are any of these geared to actual sales that need to be completed? What's the completed product inventory going to look like? We've produced these goods, they're going into inventory, and then the sales figures. Or is there a need to build up the level at various times? We then need to look at selling costs, payments to salespeople and bonuses for actual sales performance achieved. What's the final sales budget going to look like? Debtors. What's the debtors' days outstanding? Are there special terms that are reflected in the sales budget for various key customers? And has there been negotiated extended terms? I hope not, but some businesses do this to some debtors to get their business, obviously. And then within the cash flow forecast, obviously the payments and the receipts from the various other items contained within the key drivers will be reflected. And then there's the periodic payments for capital expenditure, for loan repayments, for dividend payments, acquisition of other businesses, etc., can all be shown. So this is the process of planning in a structured way the development of budgets and cash flow forecasts. It's definitely not taking last year's figure and adding a percentage. Predictive accounting requires you to go back to the very basics and start building up block by block as we work through the key drivers to determine what is happening within this business on an overall basis and in accordance with the strategies documented within the business plan. Want to know more about this process? We have a special webinar on this Wednesday, the 9th of June at 12 noon AEST, with the keynote presenters being Paul Barnaby, the Australasian manager of Plan Guru, and Trip Graham, the International Marketing Director of Plan Guru USA, and myself. And we're going to discuss the intricacies of the development of predictive accounting that you, as an accountant, business advisor, or bookkeeper, can utilize to assist your clients in this very essential process of documenting the financial picture of what their strategies within the business plan are indicating. I look forward to you joining us on Wednesday. To register, please click on to the email you've received from us and register that way, or you could go to our website, www.essbiztools.com.au. Have a great day. Goodbye.